Hi, welcome to this tutorial. So in this today tutorial, we are going to conclude our last sessions, that is ratio analysis, and we are looking into how to interpret different ratios like liquidity ratios, leverage ratios, market ratios, and finally we will go through the pros and consequences of ratio analysis. So let's start with the liquidity ratios. So we are just going to wrap up in this today session. We are not explaining too much. We are just going to wrap up. So what is liquidity actually? Liquidity is the ability of a company to pay its short-term liabilities by using its own current asset. It's the ability of a company to pay off its current liabilities by using its own current asset without raising an external fund. So how to measure the liquidities? The key liquidity ratios are current ratio. We already discussed current ratio, quick ratio, and cash ratio, again working capital. These are the four important metrics to analyze the short-term liquidity. Even the current ratio, in the current ratio, it is comparing current asset with current liabilities. In the quick ratio, it is comparing quick asset with current liabilities. In the cash ratio, it is comparing cash and cash equivalents with current liability. In working capital, what we are measuring? The total available working capital in the company. So once we calculated all these liquidity ratios, how we will interpret this ratio? No a global benchmark for liquidity ratio, even for any other ratios. It's all depend on the industry you are operating, the business structure you are operating, and your previous performance, the way you are operating the company. All these will have to consider when we are analyzing or where we are interpreting a liquidity ratios. For an example, in some industries, like if you are offering lot of credit to clients, like a big manufacturing company or a big trading company, that you are offering big credit to your clients, definitely you have to maintain lot of current working capital with you. So in that case, you have to invest in working capital rather than an industry which is providing a smaller or a lower credit to customers. Again, if your suppliers are willing to give more credit to you, you can work with or you can manage your operation with a small or a lower working capital. Again, if you have to pay to your suppliers in advance, then your working capital requirement will be vary. So again, all these ratios, the liquidity ratios, has to be analyzed, has to be interpreted by using all these consideration, like your business model, your industry benchmark, and your operating style are to be considered when we are analyzing the liquidity ratios. Then the leverage ratios, that is the second ratio. So in the leverage ratio, what we are measuring? We are measuring the portion of debt in your capital structure. That means how much you financially leverage your operations by using the capital structure. Again, in this part, we discussed two types of leverage. One is financial leverage and one is operating leverage. Financial leverage means use of debt fund in your capital structure, and the operating leverage means use of fixed cost asset or use more capital asset in operation, and definitely we will increase our fixed cost and reduce the variable cost per unit. So this is about the leverage. Again, when it's come to financial leverage, it's mainly measure the debt in your capital structure. Again, when it's come to financial leverage, it should be properly manage the debt in the capital structure to create more value to shareholders. If you manage debt very effectively, definitely you can create more values and you can deliver more result to shareholders. But in the same times, you have more debt in your capital structure and you are not managing your debt effectively, then the financial burden can come into company, like the insolvency can happen, and there are a lot of fixed payment related with the debt. So this also going to affect your business. So in the leverage ratio, again, similar to liquidity ratios, there we cannot say a global standard or a global benchmark for the debt equity ratio or the debt to asset ratio in your business. Again, it's depend on your capital structure. You would like to work your uh, long-term financial goals. Again, your preferences, your honest preferences, management preferences. All this has to be considered when we are analyzing a leverage ratios or leverage analysis. The next topic what we discussed is capital structure and solvency. Again, it's also coming under the leverage. Again, when we are deciding a capital structure, there are a lot of factors has to be considered, like your long-term business goal, your investment growth goal, or what growth you are looking for, what is your business mission and vision, and the management preferences, shareholders preferences, all has to be considered when we are analyzing the capital structure. Again, the solvency we already discussed, we already covered in the leverage ratio is the ability of a company to meet its long-term obligations. If a company's capital structure is highly leveraged, then there should be a lot of long-term financial obligations can happen in the future. So the solvency is measuring the ability of a company to meet this long-term financial obligation. Again, in the debt, in the case of debt, it will come like the repayment of debt, again the periodic payment of interests or the other charges also come. So the solvency is measuring the ability of a company to pay off or to set off its long-term obligation once it is due. The earning, the first ratio, and this is second ratio, and the third ratio we are going to cover is earning coverage. So earning coverage is measuring the how many times the company can pay off its fixed financial charges by using its own operating income. Just assume if a company have operating income of 1,000 and its fixed charges is 100, that means that 10 times this company can pay off its fixed charges. So the earning coverage ratios are measuring how much times the company can pay off its fixed charges by using its own operating income. So sometimes it is using its own cash flow as well. So the earning coverage ratio is measuring how much times the company can pay off its fixed financing charges by using its own operating income or its own operating cash flow. Again, when we are interpreting the earning coverage, it again can vary from different sector to sector and the industry to industry. So before we are setting a benchmark in the earning coverage, we have to consider our industry benchmark and the way we are operating the business and how we integrated or the financial leverage into our capital structure. All these factors has to be considered when we are analyzing earning coverage ratios. The fourth category of ratio what we discussed is activities ratios. So activities ratios mainly measure the operational effectiveness and efficiency of a business. So how much days, how effectively the company is managing its inventory, how effectively the company is managing its receivables, again how effectively the company is managing its payables. The activities ratios, it's measuring overall how effectively the company is managing its current asset and current liability to generate more value to the business. So the key ratios are account receivable turnover, account payable turnover, inventory turnover. Then we discussed is operating cycle and cash cycle. These are the key terms we discussed in the activities ratios. In the account receivable turnover or days in account receivable is measures how many days it will take to collect the receivable once after the sales. In the days in inventory it measures how many days the inventory is kept in store before it's selling to customer. Again, the accounts payable ratio it is measuring how effectively or how many days it will take to pay my payables after the purchase. Then the fifth category what we discussed is profitability ratios. The profitability ratio, the key ratios are GP margin or gross profit margin, then the operating profit margin, and the net profit margin. It's all comparing GP, operating profit, and net profit with the net sales to see how much proportion of the sales is the gross profit, again the operating profit, then the net profit. How much proportion of the sales is the profit. Again, when it's come to the analyzing this profitability ratios, you have to consider the industry benchmark for the profitability ratios, because it can be vary from different industry to industry. Normally, some industries will have a greater profit margin, a higher profit margin. But when it's come to some industry, the net profit or the operating profit margin will be very low. So we have to consider all these factors when we are comparing the profitability ratio with the other company, or we are benchmarking our profitability ratios. The sixth category what we discussed is return on capital. Return on capital or return on assets. The next category what we discussed is return on capital or return on asset. Return on capital or return on asset, we are comparing our profitability with our invested asset and the total capital. So what we are doing here, we are comparing, we are connecting our net profit or the operating profit with our capital, total invested capital, and again the total assets. So what we are doing here, we are analyzing how much the effectively we are using our capital or the assets to generate the profit. Again, it can vary from the industry to industry. The benchmark can be vary from industry to industry. So when we are interpreting the ratios, there are a lot of consideration has to be happen, like our even the capital structure, long term business goal, and a lot of factors has to be considered when we are analyzing this return on capital or return on asset ratio. The seventh category what we discuss is market ratios. Market ratios is connecting the share price or share market with the financial statements. It is purely looking an investor point of view. So how once I invested in an investment, how much return I can expect from this investment in the form of dividend, in the form of capital appreciation. So in the market return ratios, these factors is considering. It's comparing its earnings with the market price, and again it's how much I'm earning with the market price and how much I'm getting as a dividend when you're comparing to the market price. So the investors, especially somebody's like to invest in the stock market in a business, so that can give an insight to them. So what would be their real return they can expect from that cash flow or from their investment. So this is the key ratios categories what we discussed, that is liquidity ratio, leverage ratio, earning coverage ratio, activities ratios, profitability ratios, return on capital or return on asset, market ratios. So what we did now, we just wrapped up our discussion in the ratio analysis. Now we will move into advantage or disadvantage of ratio analysis. Let's start with the advantages. This is ratio analysis, disadvantages. So the key advantage or key feature of ratio analysis is this is connecting different values in the financial statement. Maybe one value from the income statement and another value from the balance sheet, or the both values from the either income statement or balance sheet. Again, it is connecting, it's analyzing the relationship between two values in the financial statements. So first advantage will say it's relationship between the two or more values. The financial statement itself is telling a story. So when it's come to the ratio analysis, it is connecting different values in the financial statement, and it is giving some insight on the business performance. Again, it is helping the comparison. The financial ratios are very helpful to compare the performance of the company Maybe we can compare with the industry benchmark, or we can compare with the previous performance to see how business is performing over a period. Again, we can compare this with this help us to compare with the industry benchmark and the previous performance. All these can use, or we can benchmark even the industry benchmark or previous year performance to make a comparison of financial ratios. Again, the third advantage, let's say it is revealed trends. The financial ratios definitely will help to reveal the trend when we are comparing it with the previous year performance. Definitely, you can get just assuming the year one, year two, year three, just comparing like this. We can say that from year to one, two, three, how it is moving each ratios, it is improving or it is declining or it is keeping the same trends. All this can be revealed, or the trend over the period can be revealed through ratio analysis. Again, the next advantage will say it is help us to build the budget or forecast. So the ratio analysis definitely it is help us to build the budget or forecast. So definitely we are, if you have build a ratio analysis over a period of time, definitely we can reveal that trend, or we can analyze that trend, and we can forecast or budget the values for the next year or the coming periods. Again, it helps to manage the performance. All the ratios are the performance metrics then the company can compare with the industry benchmark or the previous year performance. So definitely the ratio analysis help us to give some indications on the direction of the business, what direction it is moving, or what performance it is delivering for a period of time. So definitely it can give some indication of how company is performing. So this will help us the management, or help the management to improve the performance of the business. Again, let's say it is help to improve the efficiency. Okay, once we analyze the performance and we get some insight about the performance, how the company is now currently operating. So definitely it will help to improve the performance or efficiency by taking some action to improve the performance. So these are the some advantages that we can say with related to financial statement. At the same time, there are some limitation as well for the ratio analysis. Let's come to the limitation. Again, when it's come to limitation, the ratios itself not telling nothing. The ratio itself not significant, not relevant. If you're just taking a ratio of a financial statement and we cannot directly tell what the trend or what is significant with the ratios, because we have to compare the ratios with across the industry or the previous year performance or our benchmark to reveal some insight into ratio. The ratio itself, they cannot, it can, it cannot tell the complete story, can give just an indication only. Again, the whole story will tell with the comparison with the industry benchmark and the previous year performance or the standard ratio that we are set. Again, it's providing the analysis, not the solution for the problem. Just assume if we did the brief ratio analysis and we can come with some analysis, not a solution for the problem. Again, it's reveal the problem what inside the business, and it's not directly providing a solution. Definitely that identifying that problem will help the business or the management to detect and resolve that problem. But the ratio is itself, it's not providing any indications or any solution for that problem. It's just indicating there is a problem or there is a uptrend or downtrend in the business. So the it's providing an indication only, not a solution. Again, it's we are preparing the ratio by using the financial statement. We all know that there are some limitations for the financial statement, like depending on the historical performance or historical activities. and it's not considering the qualitative aspect or qualitative concepts. There are a lot of limitations like this for the financial statement, and the different accounting standard can be used, or the different currency can be used, different accounting method can be used. There are a lot of limitations for financial statements. So when an analyst preparing a ratio analysis, definitely he's depending on the financial statements. So all these limitations pertain to financial statement can affect the ratio analysis as well. Again, the qualitative factors are not considering only the ratio analysis. We are not considering any of the qualitative analysis. Is considering only the quantitative or measurable analysis only. In a business, there are a lot of things then the qualitative analysis or qualitative things can make the changes in the business, like the employee satisfaction, customer satisfaction is some of the example for qualitative factor that make an impact in the business. But in the ratio analysis, even in the financial statement, it is not considering the qualitative factors in the business. It's just considering only the quantitative factors. So this can be a limitation to financial statement analysis. Again, the same limitation of accounting standard, that is different accounting standards. So as we know, there are different accounting standards like IFRS and GAAP, and the different accounting methods as well, like the valuation of depreciation, valuation of assets. So all these differences can affect the ratio analysis as well. Just assume if you are comparing two companies with which are operating two different accounting standards, so the comparison cannot be that much effective. So when we are analyzing a financial statement, or we are interpreting a financial statement, these are the some limitations of the financial analysis. So this we have to consider, or we should keep these limitations in mind when we are doing a financial ratio analysis. We are just going to conclude today's discussion. So what we discussed is the just wrap up the different ratio analysis like liquidity ratio, leverage ratios, activities ratios, market ratios, and profitability ratios. And we just discussed the advantages or the limitations of the ratio analysis. So if you have any doubt or you need extra clarification on any of this topic, please let me know on the comment section. Thank you for watching this video.